I'm Larry Ray, President and CEO of American Manganese, Inc., listed on the TSX Venture, ticker symbol AMY, A-M-Y, with proprietary patents in the U.S., China, and South Africa. Our focus is on recycling lithium-ion batteries for electric vehicles. China recently legislated the responsibility for recycling onto their electric vehicle manufacturers and importers. For more information, please visit AmericanManganeseInc.com or phone me, Larry Ray, at 778-574-4444.
You're listening to HowStreet.com radio, available online at TalkDigitalNetwork.com. Welcome to HowStreet.com radio, the online source for market opinions. Here is Jim Goddard.
My guest is market historian Bob Hoye. He's the chief investment strategist for Institutional Advisors. Welcome to the show, Bob.
Yeah, Jim, good to be with you.
Commodities still not the favorite of anybody right now.
Oh, yeah, it has been well, I hate to use the term slaughter, but it's been relentless. From a cyclical peak in 2011, which at the time, you know, all the technical stuff was so excessive, and we've got one of our rare momentum peak forecaster cells on it, which says when it comes in, it sort of says cyclical change. So it turned out to be maybe a secular bear market in commodities, and all the way down, the commodity bulls keep looking at the reckless central bankers and money supply and all that sort of stuff, and yeah, money supply grew, but commodity prices kept going down. And the instruction on this, Jim, I think, is that it's the public that chooses what will be speculated in when the central banks are being reckless. And of course, what were they speculating in? Lower grade bonds, high grade bonds, and stocks. So you've had commodities come down all the way here and making new lows, whether you look at the commodity index of base metals or the grains or an overall commodity index like the DBC. New lows earlier in the week. So, but in looking at this also, we can call a couple of months ago talking about copper, and that we were looking for a seasonal low around November. Well, we got the low, and this is November. And for crude oil, we were looking for a seasonal low around December, and, well, we're not quite into December yet, but, hey, maybe close enough. So some of these are oversold. You also, in the last part of the decline, the U.S. dollar had taken a pretty good rally over the last few weeks. It got up, dollar index got up to 99 and change. And that, of course, is always a downer. But at any rate, the dollar index got a little overbought, and we think it can trade sideways here around 98 for a number of weeks. We got the seasonals for some of the key commodities like copper and crude oil. So we're actually, they got very oversold, whether you were looking at which index, you know, the GKX, which is the base metals, or GYX has been actually recovering. That's the grains. They've been recovering for a little while, and then coming down recently held somewhat above the previous lows, whereas base metals went right down and made new lows. So I think we can get a relief rally. And you recall last year, around this time, you've got this seasonality again, and we were looking for what we called a rotation, where some beat-up commodities can do a rally maybe out into February, March, something like that. And it worked quite well last year. I recall we used in writing, we used a small r rotation to designate that it wouldn't be a huge one, whereas the year before we used a capital R in rotation, and that was a very good one. So let's look for some sunshine in some of the commodity markets. This is more for traders than for investors, and it'll be a positive going was quite all right. Now, going other way on this, of course, there's been a good bid for Treasury bonds until a little while ago, but even recently, a little rally going on here on the TLT from 118 up to 120. This could go a little further, but if there's a decent rally for commodities comes out, they may not, long bonds may decline a little, so we don't see too much there. On the junk markets, the credit spreads, that's just still dangerous territory out there. We've had a rally in junk with the rally in the overall stock market, but this is precarious in here with that. Credit spreads narrowed from the whack into October 2nd. That was when we know that the employment numbers in the U.S. are rigged, but even rigging couldn't make a bad one look good, so it was a bad credit report or employment number, and that was sort of a let's get out of here kind of market where junk bonds were sold and became oversold, so they've had a rally. And with that, you've had the narrowing of credit spreads, which has generally been helpful to the stock market. And now, for the last few days, it looks like the narrowing of spreads has ended, and it might take a bit of work into next week to get it turned around and see if we're back to widening, which would be a caution on, say, the financial side of the market. Also looks like we're getting a change in the yield curve, which is the difference in the Treasury market between long-dated ones and short-dated. It's turning in a direction that may not be too friendly for the financial and banking stocks. So this is maybe part of the rotation. Resource-type stocks, base metals, that sort of, maybe even crude oil, the oil patch stocks, beginning to perform a little better when maybe the bank stocks begin to underperform. So that makes sense overall. But what we're going to like most out of it, Jim, is it'll be nice to see a rally for the precious metal sector, which I think is possible, and that'll pull up some of the gold stocks. So, let's put it down as a very interesting week.
We'll have more with Bob Hoye right after the break.
I'm Larry Ray, President and CEO of American Manganese, Inc., listed on the TSX Venture, ticker symbol AMY, A-M-Y, with proprietary patents in the U.S., China, and South Africa. Our focus is on recycling lithium-ion batteries for electric vehicles. China recently legislated the responsibility for recycling onto their electric vehicle manufacturers and importers. For more information, please visit AmericanManganeseInc.com or phone me, Larry Ray, at 778-574-4444.
More and more people are looking to the internet for intelligent, riveting, and thought-provoking interviews. To advertise on the Goddard Report and TalkDigitalNetwork.com, call 604-699-8600, 604-699-8600.
Welcome back. We're speaking with Bob Hoye. Everybody's watching the U.S. Fed to see if they will hike interest rates in December. Will they, or have the recent events in Paris changed things for them?
I don't think events in Paris, as offensive as it has been, is going to change anything in the financial markets. And again, the endless debate, the Fed has now become an embarrassment. It is so unprofessional. I think maybe about a year and a half ago, the talk about raising their administered rates started, but at the time I thought that, hey, these guys aren't ever going to try and quit, because if they're seen raising rates and it pushes off a bear market for stocks, they don't want that. They can't. These guys can't handle a bear market. So anyways, it's all a fraud. And then if you look back on, at least back in the 1870s, on every great bubble, the beginning of one and the end of one and the crash, following one, and looking at the record of the senior central bank, they've been 3 to 4 to 5 months behind the change in market rates of interest. And I'm going to emphasize that there are two kind of interest rates out there. One is the market rate, which is set by market forces, and then the other is the central bank administered rate, whether it's Fed funds or the discount rate. That's the one that they change. And the record is that they've always 3 to 5 months behind the change in market rates of interest. So where you've got a whole industry built up analyzing what the Fed's going to do in interest rates, it doesn't matter. So there's a possibility that Treasury rates, long dated, could increase over the next, say a few months or something like that. But you got a philosophical issue in here where the market rates of interest have started up. At the same time, you've had this ramp up in the talk about the Fed raising its administered rate. So which is causing which? I think the market rates are the ones to follow. So what the Fed does and says is absolutely worthless. I'm going to repeat that, worthless. So anyways, I'm not going to speculate on what the Fed's going to do, but I think that longer dated Treasury rates can go up. And I think that, say, moving out to March or April, you could have rates for the lower grade bonds moving up as well. So, and that could be quite important to the markets.
Bob, thanks a lot for chatting with us.
Good to be with you, Jim.
My guest has been market historian Bob Hoye. He's the chief investment strategist for Institutional Advisors. Their website, institutionaladvisors.com. You're listening to HoweStreet.com Radio. Our popular YouTube channel is Talk Digital Network. Find us on Twitter at Talk Digital Net. Comments or questions for the show can be sent to info@HoweStreet.com. I'm Jim Goddard.
Comments made on HoweStreet.com Radio are an expression of opinion only and should not be construed in any matter whatsoever as recommendations to buy or sell any financial instrument at any time. Available online at TalkDigitalNetwork.com. HoweStreet.com Radio is a production of Howe Street Media Incorporated.